Welcome back to second session of chapter 4, that is Reconstitution of Partnership, Admission of a Partner. In this session, we will be doing some of the problems. I am going straight to question number 49, where before this, the questions will be very easy if you understand this problem in short. So let me read out question number 49. Following is the balance sheet of A and B, sharing profits as 3:2. On the liability side, you have creditors, employees provident fund, contingency reserve, workmen's compensation fund, investment fluctuation fund, capitals of A and B. Goodwill on the asset side, debtors less provision, land and building, plant and machinery, investment, market value rupees 2,400, stock, bank, advertisement, expenditure. Additional information. On admission of C for 1/6 share in the profit, it was decided that A. Provision for doubtful debts to be increased by rupees 900, value of land and building to be increased to 12,600, value of stock to be increased by 1,500. The liability of workmen's compensation fund was determined to be 7,200. Investments are to be brought down to market value. C brought in as his share of goodwill rupees 6,000 in cash. C was to be further bring cash of 9,000 for his capital. A unrecorded furniture having a value of rupees 3,600 is to be brought into the books. Prepare revaluation account, capital accounts and balance sheet of the new firm. So in this problem, we will have to revalue the assets and liabilities because there are in certain cases they are increased and in certain cases they are decreased. So we will have to see by preparation of revaluation account. First we have land and building. So in your additional information, land and building was stated to be increased. So it was increased by 1,800, and stock, even the stock was increased. So by stock, the stock was increased by 1,500 and the furniture was increased by 3,600. So this is on the credit side of revaluation account, where there is increase in the value of assets. And on the debit side, to provision for doubtful debts. The provision for doubtful debts is increased. It is in your additional information. It is given the provision for doubtful debts was increased by 900. That is, there is an increase in the value of liabilities. So when you total this one on the credit side, that is 6,900. You will get 6,900 in total, and compare to on the debit side with 6,900, there is a shortage of 6,000, which means this 6,000 is a profit on revaluation. So this profit has to be transferred to A and B's capital account. Here we are not including C because this profit was earned before the admission of C. So C is not entitled to get his share of profit in 6,000 because he was not admitted and he did not take active part in the partnership firm, so he is not entitled. We are distributing this 6,000 between A and B in their profit sharing ratio, old profit sharing ratio, that is 3:2. So this 6,000 is a profit. So their profit sharing ratio is 3:2. That means A's share will be 6,000 into 3/5. So you will get 3,600. And also for B, it is 6,000 profit into his ratio is 2 divided by 5. 3, 4, 5. So it comes to 2,400. So this is how the profits are distributed between the old partners. Next is, we will have to prepare the partners capital account. We have 6 columns with the 8 columns, but these columns are meant for all the partners A, B and C. But due to lack of space, the particulars column is very small, and you should remember this. There is a debit, credit, partners capital account, particulars, column for A, B and C, particulars, column for A, B and C. This is a particular. I've just written BAR, but it should be written as particular. Please don't use shorthand while preparing the notes. So on the credit side, let's see. By balance brought down. This is an opening capital balance for A and B. I'm not writing here capital because the heading itself already stated it is a capital accounts for partner. Therefore, this is a opening capital of A and B that is already in your textbook. By contingency reserve. This is a reserve. This is a reserve which has to be distributed between A and B and not C. So this is a reserve that is being kept by the partner A and B in an old partnership before admission takes place. So this has to be distributed in the ratio of 3:2, like the calculation for reserve and all accumulated profit and losses will be same. That is in the ratio of 3:2, like this. So it is 10,260 for A and 6,840 for B. By workman's compensation fund. This is by workman's compensation fund. This is also another type of reserve. This is also certain portion of profit was get for the workers. So this is also another reserve accumulation. Therefore, this is also distributed in the ratio of 3:2 between the old partners. That is 1,080 and 720 in the ratio of 3:2. Again, on the debit side, the goodwill. This goodwill was already existing in the old balance sheet. That is 3,600. So this 3,600 is written off. It is written off by partner A and B in the ratio of 3:2. So do advertisement expenditure account. This is also a reserve, accumulated profit. So it is 1,800 and 1,200, which means the market value is already taken into account. So this is distributed between the old partners and not the new partners. Let's go to the next page. First, decide. By investment fluctuation fund. Investment fluctuation fund. It is supposed to be 900. But investment are to be brought down to market value. That means it is already given in the additional information E. So when you look there, it is 3,000 minus 2,400. So it comes to 600. This 600 has to be again deducted. That is 900 minus 600. It is 300. So only this 300 has to be distributed between partner A and B in the ratio of 3:2 in their old profit sharing ratio. So this is by revaluation account. Next, revaluation account is a profit that has been occurred, that has been calculated while preparing revaluation account. So in your revaluation account, go back to revaluation account, you will see on the debit side that the profit of 6,000 is distributed between partner A and B like 3,600 and 2,400. This is the profit that has been earned in your revaluation account. Next is by bank account. This bank account is a cash that has been brought in by the new partner, that is partner C. So in your additional information G, you can see there, C has brought in 9,000 as his capital. So it will come in the C's capital account. By premium for goodwill. So the premium for goodwill is 3,600, 2,400. That has been already brought in by the partner C. That is, new partner has brought in 6,000, which is distributed between the partner A and B. So the total balance, after totaling the credit side and also totaling the on the debit side, you will have to balance carried down. That means 23,760 for A, then 15,840 for B, and 9,000 for C. Which means this is now the capital amount for A, B, and C after preparing the capital account. So this amount will be taken into account as their capital while preparing the balance sheet. Which means the all capital of all partners, that is 9,000 and 6,000, will no longer be used, but their current capital has been increased already here. So this will be taken into account. Next we have is balance sheet. In the balance sheet, on the asset side you see, debtors was 13,200, which is given in your balance sheet, and provision. This provision was already provided in your additional information A. So provision comes to 1,500. That means 900 plus 600. So it comes to old one and new one. It comes to 1,500. So now the debtors stood at 11,700. Land and building is 12,600. Plant and machinery is 4,200. That means land and building, I'm forgetting to mention this. Land and building, there was a depreciation. So you will have to deduct the value of depreciation and you will get 12,600. Plant and machinery also, you will have to give depreciation and then it comes to 4,200. Now on the liability side, you have creditors 6,000. There is no change. Employees provident fund is 4,600. So this is also no change. Next on the asset side, you see investment is 2,400. Stock is 8,100 and bank is 24,000. And this furniture stood at 3,600. So bank, let me come back to bank. When you look at on the asset side, when you look at the bank balance, it is 9,000 here, 9,000, and also the amount of goodwill that is being brought in by the new partner is 6,000 in cash plus 9,000, that is an amount of capital that is being brought in by the new partner. So the bank value, the balances at the bank will increase to 24,000. Next on the liability side, you see liabilities for workmen's compensation is 7,200. So this is the capitals. Capitals of A, B, and C are being brought down from capital account. When you go back to the capital account, the balance carried down is 23,760 for A, 15,840 for B, and C 9,000. So it comes to 48,600. This is how the accounts are to be prepared when the admissions takes place. So the financial position of the concern now stood at 66,600 each. Next, let's go to question number 54. Question number 54. A and B were partners in a firm with capitals of 72,000 and 96,000 respectively. They admitted C as a partner for 1/4 share in profits on his payment of rupees 1,20,000 as his capital and 54,000 for his 1/4 share of goodwill. On the date of admission, the creditors of A and B were rupees 36,000 and bank overdraft was 9,000. Their assets apart from cash included stock rupees 6,000, debtors 24,000, plant and machinery 48,000, land and building rupees 1,200. It was agreed that stock should be depreciated by 1,200, plant and machinery by 20%, 3,000 should be written off as bad debts, and land and building should be appreciated by 25%. Prepare the revaluation account, capital accounts of partners, and the balance sheet of the new firm. Let's see revaluation. So the land and building was increased by 30,000 here. Stock is 1,200. Plant and machinery 9,600. Bad debts written off 3,000. To profit on revaluation is 16,200 into 1 by 2. 1 by 2, that is 8,100 for A. B 8,100, that is it comes to 16,200 for the profit on revaluation. So in this problem, one thing you should remember is that there is no ratio. The ratio of the sharing of profit and losses are not mentioned, which means you will have to ascertain that these partners are equal partners. So the profits are shared equally. Capital account. Next is capital account. That is on the credit side you have by balance brought down, that is the opening capital of partner A and B. By bank, that is the value of capital that has been brought in. Then by revaluation account, profit on revaluation. Then by premium for goodwill, that is the goodwill amount that has been brought in by the new partner. That is the amount of 54,000 is distributed between partner A and B equally, which means they are equal partners. They got 27,000 each. So on the debit side there is no particulars. Therefore the balance has been carried down. The amount of capital now stood for A 1,07,100 and for B 1,31,100 and for C it is 1,20,000. So this is the new capital amount. So in the balance sheet, bank overdraft on the liability side is 9,000, creditors 36,000. Then on cash in hand, I will show you this in your working notes. Balance, plant and machinery is 4,800. Depreciation is 9,600. Therefore, the value of plant and machinery has been decreased to 38,400. This is supposed to be 48,000. Next is land and building. Land and building is 1,20,000 in your balance sheet, but it has been already appreciated. Appreciated means it has been increased. For plant and machinery, it was decreased, depreciated. For land and building, it is appreciated, increased. When it is increased by 30,000, it has to be added. The value of land and building has been already increased by 30,000, so it is 1,50,000 now. Stock is 6,000, but it has been reduced by 1,200, so it comes to 4,800. Debtors was 24,000. There was a provision of 3,000, so it is 21,000 now. Capitals of partners that has been brought down from capital accounts are 1,07,100, 1,31,100, 1,20,000. So it comes to 3,58,200. So the financial position of the concern is 4,03,200 now. And regarding the the bank balance, in your question, the bank balance is only 9,000. So you will have to prepare memorandum of balance sheet, that is on the opening before C's admission. So on the asset side you have land and building 1,20,000, stock 6,000, debtors 24,000, plant and machinery 48,000, then cash. Here creditors 36,000, bank overdraft is 72,000, A's capital, B's capitals are 96,000. So the balancing figure is 15,000. So out of this 15,000, let's see here, cash. Cash account is, balance brought down is 15,000, that is already in your question. Then to premium for goodwill is 54,000, that is brought in by new partner. To C's capital is 1,20,000, that is the capital amount brought in by C. And the balance carried down is 1,89,000. So this 89,000 is already entered in your balance sheet, that is on the asset side of your balance sheet, where the amount of cash has been increased. So these are the things that you will have to prepare in order to ascertain how the profit and losses has to be distributed when the new admission takes place. With this, we have come to the end of this session, and in the next session we will be doing some of the problems. Thank you.